Welcome to the Real Estate Secrets podcast for healthcare professionals, hosted by Austin Hare and Nathan Palmer, who together have over 2 decades of real estate knowledge and investing.
Hello, everybody, and welcome back to the show commercial Real Estate Secrets. We have a guest today. His name is Paul Birkett. He's the founder and the CEO of Automation Finance. And so he started in corporate America, and now they buy distressed mortgages and they fix them. And they're the only ones doing this. They've been doing it since 2013. Paul also has built a portfolio of rental homes across the U.S. And so without further ado, I welcome Paul Birkett. Paul, thanks for hopping on the show today.
Hey, Austin. Thanks for having me on.
All right. So I'm sure listeners are going to detect an accent. So where are you from and where do you live now?
Well, it's so funny because people often say to me, hey, you've got an accent. Where are you from? I say I'm from Queens. And they look at that quizzical look. Is this guy for real? But no, I'm from Dublin, Ireland, and I came to the US in 2010. This business is actually my second act, if you like. My first 25 years was in corporate America with PepsiCo and Procter & Gamble. So lived all around the world with them in the consumer goods business. Came to the US in 2010 and was working with them for the first few years before I started Automation Finance.
Okay, so you were with PepsiCo, you said 25 years?
About 18 years with
18 years.
Pepsi and about 5 years with Procter & Gamble before that.
Procter & Gamble, okay. All right, so how was it working for them? I'm sure you must have just learned a ton along the way.
Oh, it was spectacular. When I say I was there 18 years, I can't believe it was 18 years. The time went by just so fast. And, it has the appearance of a glamorous business, and a lot of it is glamorous. And so you spend a lot of time working on very exciting projects. And I guess like anything, an exciting project becomes a project pretty quickly. So whether it's making an ad or whatever it would be, the various things that we did back in those days, one project is much like another. The output is just very different. So yeah, it was great. I really enjoyed it.
What I like asking people, what do you think was like your biggest learning experience that might have resulted as like from a failure?
Oh, you had so many failures. I mean, if you're looking at a PepsiCo or any of those big companies, your competitors have all the same information that you have. So it's not like there's some secret that you can use to unlock to get growth. And so you're grinding out 0.1% of growth each year on each line of business. And typically the mistakes will come from making too big of a bet on a certain feature that just doesn't work out. So I couldn't even remember the number of new products, new flavors that we tried and just didn't work out. They may work out for the first 6 or 9 months, but no one really sees sarsaparilla flavored Pepsi anymore. That was not one of our finest moments.
Oh, that's great. Okay. So you're inside, as you dubbed it, corporate America for a long time. And then when did you start buying these residential properties?
Well, I came to the US in 2010. I wasn't educated in the US. I'd never lived here. I had been to the US many, many times and always wanted to live here. And I'd said on my career development plan with my employer, hey, I'd love to come to the US. But that takes a long time because guess what? Everyone wants to come to the US. And so I got here in 2010 and there was a corporate retreat at Marco Island, which is this fancy resort down in Florida. And checking out of the hotel one Friday or on Sunday, I saw one of those realtor magazines with the fancy homes in the back. Here's where to buy your watch, here's where to buy your fur coat, here's where to buy a great home. And some of these homes were pretty cheap. I couldn't believe it. $100,000 for a 3-bedroom, 2-bathroom home in a great area. Well, that doesn't seem right. But back in 2010 or early 2011, there was the real estate market, everyone will remember, was in dire shape. So to cut a long story short, I drove up to Cape Coral, which is where these homes were, and did my diligence and ended up buying a rental home, thinking this will be great. I'll buy it for around 100 grand and it will rent for around 1,500 bucks a month. I'll get a check every month from the tenant and I have to fill in some forms at the end of the year. Piece of cake. And I did that and I ended up with about 30 doors. And what any one of your listeners will tell you, and you probably know yourself, is there is nothing less passive than single family rentals. And so I was spending every evening and all day Saturday and Sunday on paperwork admin, move-ins, move-outs, rehabs, all of that stuff. And that was on top of a pretty demanding job. So I thought, this is not going to be the passive life that I thought it was going to be. And so a short sale, I was buying a short sale from a bank, and a short sale is where the bank sells the home for less than the bank is owed. So the bank takes a loss on that transaction. And the bank called me and said, listen, we can't complete that short sale with you. We've sold the loan. I thought, oh, that's a shame. Who's the bank that you sold it to? Oh, we didn't sell it to a bank. We sold it to a local investor. And I thought, that's very interesting. An individual person? Yeah, an individual person. Okay, so cut a long story short, I got that person's contact details. I closed the short sale thinking I was doing a great deal until I figured out what the person who had bought the loan was doing. And my eyes were completely opened, which was, wow, this is a much more scalable business than trying to do single family rentals. So I spent a year researching it, and then in 2013 started buying mortgages.
Okay. All right. So you, during that first time that you did this, you essentially bought the bank sold the mortgage to a individual investor. And then you bought the mortgage from that investor, or you bought that property from him?
I bought the property from them, and
he held the note on it.
He held the note, but the important part was how the whole thing worked. And I thought, wow, this is crazy. So fast forward to 2020, we now manage 2,500 mortgages, around about $250 million, with just 6 people.
Wow.
So there's just no way to do that on single family rentals. And maybe you could do it with 60 people, but not with 6.
Wow. And you said that you're the only ones in the country that are currently doing this?
Well, we're the only ones that are doing it using crowdfunding. So there are a bunch of people who do this, and all different angles in this space. You'll see on those lifestyle TV shows where they buy the house and fix it and flip it, and those kind of shows. That's one element of it. We're not in that part of the business. We're in the business of working with the borrower to keep them in the home and get the cash flow flowing again. If the borrower is missing payments, there's a reason for it. If the borrower isn't paying at all, there's a reason for it. And so our job is to figure out what's the reason and what can we do to fix it. And typically what you'll find is it's just ordinary guys like you or I living in these homes, and we lost our job, or we got sick, or we went through some life event and got behind, maybe even for a year, or maybe even for 2 years. And so even now, with everything going on with the pandemic, anyone who's working, let's say someone who owns a restaurant or a couple of restaurants, their revenue is down 90%. So how are they going to make their note payment? Well, they're just not, because they've got to eat and put gas in the truck or whatever. So the note gets paid last. No bank will forgive those missed payments. So that loan ends up going into foreclosure. We buy the loan, hopefully before it goes in foreclosure, and work out a deal with the borrower.
Okay, so yeah, in that situation, let's just say it's a guy who's got some restaurants, like you said. They've got a long road ahead of them right now. So, and let me back up a little bit. Like when you say it's a year or two that some of these people that you've mentioned, are they paying anything? Because that seems like a long 2 years seems like a long eviction process. Like, is the bank, do they let people live in their house for 2 years without paying a dime?
Yeah, sometimes, especially with lower value, because banks are set up to make new loans and hold them on their balance sheet. That's what they're made up to. That's what banks are good at doing. And banks would say this, they wouldn't disagree. They're not good, nor do they want to deal with loans where the loan is not performing correctly. Yeah. So they want to get rid of that asset.
They just want to get it off their books.
Get it off their books, because it costs them a lot more to manage that loan than, for example, someone like us. So our advantage is we buy it from the bank at a discount. We might get 40% off, to give you the idea. Okay. So we might the house might be 100 grand, let's say, because across the Midwest, there's a lot of houses are 100 grand, just to keep the numbers round. We'll buy that maybe for $60,000. So that gives us $40,000 of wiggle room to work out a deal with the homeowner and restructure that loan.
So that's money owed on the mortgage. So the house
Yeah,
might even be worth more than that, right? The house might be worth
maybe.
120, 140.
Yeah,
Are
yeah.
you seeing a lot of equity in the houses that you're taking of the distressed debt in addition?
More and more. When we started, I was way before COVID, but I thought that lower priced homes in the US were massively undervalued.
Hmm.
And the reason they were undervalued was because you cannot get a mortgage really. A new mortgage for under 100,000 is very hard to get. You just simply, a bank won't give you one. And the reason is
I
because
didn't
it
know that.
costs them, well, it costs them about $5,000 to write a mortgage.
That's their
So can you
whole,
really, yeah,
yeah.
can you really charge a guy 5 grand on a 100 grand loan? It's very hard to get that business to work. So that segment of the market was ignored. So I originally was thinking, well, maybe we would be a low value originator. We'd write new loans for 100 grand mortgages. But it makes a lot more sense to buy mortgages that already exist and fix them than to go through the pain and cost of writing a new loan. So
Mm.
there's a number of different angles there. And so we end up with loans. All our loans are around 100,000, and all the houses are around
How
100,000.
many did you say that you have right now?
2,500 loans.
Wow.
Yeah.
And okay. And so, what happens? So like, because these people are obviously in a predicament for a reason. Now you do have an advantage is that they just owe less money, but I mean, how do you get them to start paying? I mean, and then what happens if they don't start paying? You know?
Right. So let's say they haven't paid in 2 years. Typically, what happens is let's say they get sick, they're off work for 6 months or 9 months. They could go to the bank. The bank says, well, we'll see what we can do to help. But the cycle takes a long time. So 4 or 5 months later, still nothing has happened. There's still been no like action. It's not like the bank doesn't want to help. It's just they can't do anything for this particular borrower. So the loan goes into the special servicing department. It's there for a few months. So it may be 2 years before it comes to us.
Mm.
And the guy in the home that we spoke about earlier is saying, I need to live somewhere. I can't afford to make up the $30,000 or $40,000 of missed payments. So what can we do? And so the math is simple. The talk off with the borrower is very simple. Let's say we were to foreclose, take your home, rehab it, and sell it on Flip That Home TV, one of those TV shows that you see. What would you do, Mr. Homeowner? Well, I'd go down the street and rent another home because my kids are in school, my wife works in the local store, whatever it is. So you've got to pitch your payment from the borrower at about 75% of what the rent would be. So if his rent is 1,000 a month and you tell him his mortgage payment can be 750, well, it makes no sense to not pay. You get to keep an appreciating asset because these low priced homes are appreciating at 7 or 8% per annum. So he's seeing it going up from 100 grand to 110 grand this year. Well, why would I want to lose that? So I'll keep it. It's cheaper than renting. Everybody wins. And so that's how the economics work.
Okay. And so, what kind of like, with the borrower, the guy who owns the house, or I guess he would be, you are now the lender, he is now the borrower.
Right.
What are the terms of those loans? Because right now the interest rates are really cheap through traditional mortgage. Right now the interest rates are really cheap through a traditional mortgage, and but historically, I mean, they've been all over the place. So I imagine maybe you're seeing like different interest rates. Are you like, where do you guys come in at? Or how do you determine that? Really, is a better question.
Well, it depends on what the borrower can afford. There's no point putting some guy into a payment that he can't keep up. So you've got to get to that 75% of rent equivalent. And in many cases, that will mean we'll be reducing their interest rate from 10 or 11% to 6 or 7%. Yes, there are mortgage rates in the market of 4% right now, but low value, poor credit score borrowers cannot access those type of loans. Therefore, much higher income people. So the typical interest rate will be 6%, maybe 7% on these loans once they've been modified.
So you're saying that they're paying 11 with the bank, and you can get down to 6 or 7. Is hearing you right? Oh, that's great. That's great for them. Okay. And how do you work out like the amount that's owed?
Well, it depends. The amount, working out how much is owed is easy. The question is, how much of it can they afford to pay? So let's say you've the house is worth 100 grand, but the borrower owes 160,000 because the value of the home fell and they were behind for 4 years or whatever. Well, you're never getting 160,000 because the house is only worth 100. So you'll structure a deal to write off the negative equity, the part that's underwater. You'll write that off over 3 years for on-time payments.
Okay, so if you guys are able to get the debt at a like, you know, whatever, you know, 40% off,
yeah.
Do the homeowners still, are they kind of still responsible to you guys for the principal amount, you know, that you bought it for? And so is there margin in those deals? Like, is that how you're able to keep funding these things?
Yeah, we always need we always try to get to around a 40% discount. So whether it's 40% off the value of the home, if there's a lot of negative equity, if the home is underwater, I'm not going to take 40% and still be underwater. I'm going to take 40% off the actual fair market value of that home, and we'll buy the mortgage.
Okay. All right. And so then I guess what this has spun into now is you guys are essentially, you've turned to the unique thing that you do is you turn to crowdsourcing to raise money for these things. Okay. So, and how does that work exactly?
So up until now, we'd raised money from hedge funds. And when you take a look back, we've grown very quickly and we've done a lot of good work, but most of the money went to the funding sources. The money didn't come to the company. So we said, well, why are we making money for funding sources? Why couldn't we make money for ordinary folks just like us? So let's do a crowd fund and see if people are interested in investing alongside us. So what we do, since we started, we've made about 16.5% a year since 2014 when we started. Why don't we split that with an investor? So give 8 to the investor, we'll keep 8, we'll use the 8 to manage running the business and all that stuff, and 8% goes to our capital partner. And so we got regulated by the SEC, set up a Regulation A crowdfunding, and started raising last summer. And so we pay an 8% preferred return to the investor, and we pay that every month. So that's cash flow every month for people, if that's what they want. Some people would prefer to not take the cash and reinvest it. The power of compounding.
Okay, I was going to ask that if you compound that.
Yeah, most people do that actually. We get a lot of investors who have cash. They're waiting for a deal to come up. They'll put it in, and we offer best efforts liquidity. So if you need to get, it's a 5-year deal, but if you want to get your cash out more quickly, you can give us notice, and best efforts will get that cash back to you. So what that would mean is the fund would repurchase your units and issue new units to a new investor, because we have investors coming in all the time. And so that's what we do. Now, it is not an FDIC insured banking product. This is an investment and it carries risk just like any other investment. But we haven't missed any payments yet, and we haven't lost any capital yet.
That's since 2013?
Yeah.
Or how long have you been crowdsourcing for?
Oh, crowdsourcing only started 1 year ago, but we've been doing the business since 2013.
Okay. All right. So how it would work is essentially what's the minimum to invest?
$250. I'm kind of regretting that, I have to say. I thought the idea would be, because crowdfunding is pretty new, and the idea of going out and saying $250, now anyone can really invest in something that up until now was only available to hedge funds and accredited investors. This is available to non-accredited people. And we get a lot of 250s, and it's much more work than we ever thought. I didn't think we would get too many. I didn't think we would get too many 250s. But the funny thing is, you get a lot of people who come at 250, and then they put in much more a lot later.
They're testing the waters a little bit.
Yeah, exactly, to see is it real and all that. So, and that's totally fine.
Okay. So it's kind of like your entryway. You know, I'm sure you probably don't, by the time you handle all the manpower behind getting these people invested, I'm sure you don't even make any money off this $250. But
oh no, we lose money on the 250.
Yeah, it's like a lost leader, I guess.
Well, it was even a gimmick just to get. I thought I'd get more marketing spin out of it, but we really didn't get too much marketing. Most people are coming in with much bigger sums than that, but there are a substantial number of people who just come in with a few $1,000s.
And so, do you think you'll continue the $250, or do you think there's a time limit on that?
I think it's very expensive to change your proposition with the SEC, so we won't change it. But if we were to do it again, I'm really not sure that was such a great idea. So you asked me about mistakes. I'm not sure that was a great idea. And that was my idea, not anyone else's.
Oh, man. Okay. So essentially, anybody can come in with as little as $250, and that money, the first month, it would start paying an 8% return.
Yeah, $1.03, I think it is, if I remember. Because at the beginning, I was writing checks for all of these things, so sometimes
that would be time consuming. So, but it goes into one big pool. Like, you're not allocated to any one asset; it's more diversified. So
no, it's completely passive. So we take the money. We've got about 2 million on the balance sheet right now in due diligence. We'll be closing deals supposedly on the 24th of December, but I think everyone listening knows nothing closes on the 24th of December.
Oh, yeah.
It's going to close a week later, but we'll buy loans, and that will be day one, if you like, for that pool of loans. And we pool all the costs, we pool all of the revenue, we pool all of the proceeds, everything goes in, and the first 8% goes to the investor. We don't charge any fees from that. So the investor gets paid first, we get paid last.
Okay. So you mentioned something about allocating the money to get out. What does that process look like?
If you want to get out?
Yeah, like, there's no minimum, but essentially It sounds like maybe you got to line up somebody else to take their shares.
Well, that's not what's happening, but what we need to do is we will repurchase. Let's say you wanted to leave after a certain period of time, 3 months for whatever reason. So Austin sends us notice, hey, I need to get out. I've got $10,000 in right now. If it's $10,000, that's fine. We can do it in a day or two. If it's $250,000, we probably are not sitting on $250,000 of cash. So either a loan will pay off, or we will sell units to somebody else, and we'll use that $250,000 to redeem, to fund, if you like, to replace the $250,000 that you are redeeming.
Okay. And do you know about how long a process on average takes?
Well, it's only happened twice, and it was for $250 or $1,000, so it happened the same day. Okay. This is not a liquid fund that you think you can buy in and out of in a day. You should plan to be in this for the duration, which is I think it's got 4 years to run from now. But there's a big incentive, because we get paid last, to liquidate the loans as quickly as possible, because there's no revenue for the investment entity, if you like, until the end.
For you,
so
okay.
So until the investor has had his capital back and his 8%, there's nothing in it for us until that happens.
Okay. So if I'm an investor and I'm looking to park my money somewhere because I'm sitting on cash and I'm worried about depreciation, which you should be, especially right now.
Yeah.
Or inflation, I guess I should say. Then
either way.
Yeah. Then I plan to put my money in here just to be safe for, you said 4 years, 4.5 years?
Yeah. 4 years left to run.
But it's likely that you'll get someone to replace it if you did need to pull it out. It just wouldn't be instantaneous. It'd probably take, realistically, if your money's in there and all of a sudden you decide, hey, I actually want to pull it out before the term, it might take a couple of months, maybe, 2, 3, 4, 5, 6 months or something like that.
Well, the straight answer is nobody knows, because no one has ever done it. We've new investment coming in all the time, but let's say there was COVID-20 comes around the corner, and everyone wants to get out because the world they just want cash, then we will have no new investments coming in because everyone wants cash. And our current investors who are in will struggle to get out because there's no new cash coming in unless loans pay off. And ironically, our loan performance is doing way better than certainly I thought it would do, given what's going on in the economy, because there's basically been no reduction in there has been a small reduction, but it's 5%, not 50% of the loans that we currently have that are paying or continuing to pay.
All right. So, for the entrepreneurs that are listening out there, they're hearing you talking and it sounds really good. What's to keep them from starting it themselves and doing it themselves versus just investing with you?
I think that, so officially, I would say this is not an easy business to start. This is much more complex than I ever thought it would be. It took me 2 years to really figure out how to do the basic nuts and bolts of the business. But there's nothing to stop people from doing it themselves. They really can. The challenges are, it's a hard business to get started in. It's very easy to buy a home and renovate a home and rent it or resell it. It's very difficult. You need an awful lot of knowledge to buy a loan. There's licensing restrictions. There's a lot of technology requirements. There's a lot of financial analysis skills that are required. It's not a place for the uninitiated. If someone wants to do it themselves, they can. I'd suggest they partner with someone who's already doing it, and work on a pool or buy a loan that way. This is a illiquid business. The returns can be very attractive, but it's illiquid. And so we have loans that we've owned, and we're coming up on year 5. So we've been arguing with the borrower, and we've actually been in lawsuits with borrowers for 5 years. And so that can happen on a loan. If it's the only loan that you own, that's a massive problem. If it's one of 2,500 loans, it's just part of doing business.
Yeah, how did you originate the financing for the very first deal you did? Was that just something that you had to pay all cash for?
Yeah, I paid all cash for the first loan. I bought 1 loan, then I bought 10 loans, then I bought 300 loans, and then I got Wall Street financing, and we bought about 1,000 loans in a single deal. And that was a big mistake, because 1,000 loans is much more than 3 times 300 loans when it comes to managing them. It's way more complex than you would ever think. And so we had 2 years of 100-hour weeks. It was very, very challenging.
We
learned a lot.
I think of it like the same thing as buying a residential real estate property, which we discussed on a podcast called The 3 Options for Your Money. But essentially, like with residential real estate, the returns percentage-wise are really, really good. Yes. But what people make the mistake of is calling it passive income, because it's anything but passive. I mean, you are becoming a landlord, especially when you're not scaling as much. You only have 1 property or anywhere between less than 10. I mean, you don't have full-time people working for you at all. You're dealing with new tenants, tenant turnover. Anytime anything goes wrong, maybe you don't fix it, but you're calling the handyman, and that takes time, right? And you're bidding things out. And so all these things, like, the money is the same every month, regardless of how much effort you put into it, but you are going to be required to put effort into it. And then on top of that, it just doesn't really scale with the amount of money. Like, so if you buy a $100,000 house, you are going to be able to get $1,000 to, $1,200 a month, maybe, whatever it is. Right. And that's like pretty good. Like, you're not going to be making that entire amount profit because you have your expenses to go into it, but you're also not putting that entire amount down because you're leveraging your money. So like on paper, you put 10 grand down, you're getting $1,000 a month, you're keeping 20% of that. So 2 grand on 10 grand annually is 20%. That's crazy. But if you're spending a couple hours a week or a month, really, and only making $200 a month, it's like, wow, like I'm spending like 4 or 5 hours, you know what I mean? Doing all or more, maybe it's 8 hours, like, and I'm making $200. Are you kidding me? So like the thing I like about commercial real estate is the fact that it scales, because now if you have for instance, in residential, you got $1 million house, you're not gonna be charging $10,000 a month just because it's $1 million, right? Like, you're not gonna be making 2 grand a month in positive cash flow just because it's $1 million. Like your margins get lower and lower and lower as the house gets more and more expensive. And so with commercial real estate, it's like, hey, this is scalable, right? Like, it's all about the rate of, it's all about the cash flow, the net operating income. And so I think that's kind of like the similar thing with what you're offering is like, hey, listen, you can do all this yourself, you can make higher margins, but it's not passive, it's now a job. So which do you want?
Right. Absolutely right. And the only reason we don't do commercial is A, because there's a lot of people already in the commercial space, and B, it's a lot. We're looking for the most secure thing we can find, and the home that someone lives in, typically they really want to keep. So you can't walk away from a home that easily.
Right. And I'm sure at this stage, 2,500 homes, you probably have an idea of, it's just a numbers game. Like, what percentage are going to be bad? bad players, right? Like,
Yep.
do you
Yep.
know about what percentage that
Yep.
is?
It depends on the type of loan you buy. So if you're buying $300,000 homes in California, none of those are going to be bad. Very few, 10, 15%. If you're buying $100,000 homes in the wrong side of the tracks, let's not pick on any particular town or city, then you're going to have much more trouble there. But the returns may be higher. So you're going to have a lot more trouble, but you're going to make more money in the long run. So it really depends on what you want to do.
And I would imagine if you do have trouble, I mean, you own the house for 40% off of the debt.
Correct.
Means you might even have half off or more than half off. So you probably wouldn't have too much trouble finding someone else to rent it out. I'm guessing you don't want to deal with it. Do you ever in a position where you just flip them and sell the houses?
Yes, sometimes we do. Sometimes the homeowner will say, look, I just want out of this. I've left Ohio and I've moved to Florida. You can have the deed, just send me the paperwork. And what we'll do is we'll do a deal with them. Usually we pay them a few $1,000s to do that, because we may need them to sign documents later or whatever else. It's always better to go for a consensual outcome than fight with people. Now, some borrowers tell us, go to hell, we're not going to ever deal with you. You're just the same as the bank. And in those cases, those loans go to foreclosure and the home gets sold at the courthouse steps, or depending on which state and what the process is.
Okay. All right. Well, so for everybody listening, they want to get in touch with you. How can they reach out? How can they get involved? They want to ask more questions, or they want to invest, and where's the best place to go?
Well, if you want to invest, the best thing to do is go to our website, automationfinance.com. Read the placement memo. It's also on the SEC's website. And make sure you understand exactly what we're doing, because what I've talked about here is a very high level. There's a lot more detail to it. I do monthly updates on LinkedIn. So if you go on LinkedIn and link in with me, I'm Paul Birkett. And you'll see I'll pop up on your feed with monthly updates on what's going on in the debt market and the real estate market. And you can just open an account at the website. It's pretty simple, a few forms, and we'll be happy to work with you.
Yeah, no, I think you guys are serving a great niche. You know, it's you don't have a amazing deal right now to put your money in, and it's just sitting there, and you're worried that the market is going to correct massively, then it's a great way to get a safe return. That's actually really good. Right now, interest rates are 1%, so 8% is significantly better.
Well, there are no safe returns. The SEC is always listening. So everything has risk. Even holding cash has risk. We could get deflation, but we could get inflation too. So who really knows?
Right. Yeah, that's true. That's true. Well, Paul, it was great chatting with you. It was a pleasure learning about what you do. And yeah, best of luck. And we should connect again in the future.
Thanks, Austin. Pleasure being on your show and talking to you.